Hey everyone, welcome back to our next lecture. So last time we left off, we were talking about pricing options using the Black-Scholes-Merton model. And today's lecture is going to extend that to some plain vanilla cases. So specifically in our four blocks today, the thread that's going to be connecting all four of these blocks that we're going to talk about today is what changes in the BSM model when the underlying asset is not just a plain vanilla non-dividend paying stock, right? So we'll take a look at employee options um, and some of the intricacies there. We'll take a look at index options, which tend to behave like options on a dividend paying asset. We'll also take a look at currency options. And here the thread is that we're going to treat the foreign rate of interest as a continuous dividend yield effectively. And last but not least, we will talk about range forward contracts, which uh, which we'll really see as an option combination, and it's a hedge that exploits some of this put call symmetry that we've talked about before at sort of a zero cost for the hedger. Okay, so let's jump in and talk about employee stock options here. What makes ESOs, employee stock options, different? Well, it should be said on the outset here that employee stock options are call options, but they have certain frictions that off the shelf, Black-Scholes-Merton model tends to ignore. So typically, when employee stock options are granted, they are based on a notional principal amount, and the contract is usually for about 10 years. Now, you might assume that you can just plug in, 10 years into the Black-Scholes-Merton model, and then all of a sudden you have the employee stock option priced. Okay. Hmm. Now, there are several frictions um, that arise as to why you can't do that. Number one is that most employee stock options, there's a vesting period, which means you have to you have to stay at the company for X number of years. So it could be the case, for example, if the employee leaves before the vesting period, then those options are forfeited. And so you needn't necessarily have calculated, the cost, as it were, for those options. And we'll talk about that a bit more in a minute. Um, but generally speaking, because so these options are typically forfeited for those employees who do leave early before the vesting period, the sort of realistic effective life of the option is truncated to be less than 10 years, somewhere around the 4 to 6 year, 3 to 5 year sort of time period for the maturity date of these options. The other issue that arises is that these options, unlike other, exchange traded options, are not transferable, right? You can't sell these options. So the employee's only way to monetize these options is actually to exercise them. They cannot sell them. So, for the typical employee, this would encourage early exercise, which again reduces the average the effective time to maturity on these options. And especially this is especially the case for employees whose wealth is highly concentrated in their company stock. They're keen to want to diversify that as soon as they can. Um, Lastly, here is you have to deal with the options dilution effect. That is, when um, the employee exercises the option, the new shares are issued at that strike price. So that means that the existing shareholders are diluted. Um, but the dilution actually occurs when the grant is actually made, right? Because markets are forward looking here. And so the accounting standard here that requires this is, stated here. It requires firms to expense the fair value on the income statement on the date that the stock options are granted to the employee, right? So these are required to be reported as basically salary expenses on the income statement, and effectively, when the new stocks are issued, that comes out of the treasury stock account of the balance sheet. So here's an example, just valuing employee stock options with our Black-Scholes-Merton model. So what we will do here in the typical setup here, here's an example where we have a 10-year stated maturity on 1 million at the money options. So effectively 1 million underlying shares here. If the stock price is currently is $30 and you have a historical volatility of about 25, um, and through some sort of empirical observation at the company level, you might sort of estimate that the expected time to exercise is somewhere in the 4.5 year time range. So if you can look up a corresponding risk-free rate for that time period, a 4.5 year, discount rate, as it were, let's call it 5%. Then when we plug this into the Black-Scholes-Merton model, using that, for example, that Derivigem software that we introduced in the last couple lectures, you'll see that the call option here is $6.31, right? For for these options. And what I also failed to mention was that this company pays dividends on its stock. So remember how we account for that is we just adjust the current stock price, right? S0 at 30, right? The present value of dividends over that 4.5 year time period in this example is $4. So that is effectively the value of the shares in the future because of course dividend payments, right, transfer value from the option holder to the shareholder before the exercise date. And so when we calculate the value of this, of course, as I mentioned, the per option Black-Scholes-Merton value is $6.31. And because we granted it on a million underlying shares, then the expense on the income statement is going to be $6.31 million. And this expense, the 6.31 million, is spread over the entire vesting period, right? So if it's a 4 year vesting period, for example, that would be divided by four, and that would be the expense on the income statement each year. Now, there are other valuation approaches. The Black-Scholes-Merton model is the most commonly used one, but the first one we've talked about here is under this idea that we want to model potentially early exercise. That is, we can start with our binomial tree, right? And use those early exercise rules, assuming, whenever some threshold, between the stock price and the strike price, when it crosses some threshold, that that we've seen historically might empirically reflect the employee's behavior. So this would capture that state dependence, right? The expected life um, um, tends to, the expected life shortcut might miss, right? So for example, the employees might exercise sooner, right? They might exercise sooner when the stock price has gone up a lot. So it's not going to be on a fixed clock like that, the prior Black-Scholes-Merton slide example shows. Now the second one here is pretty creative, and it's only been used a handful of times. The first of which was in 2007 when Zions Bank Corp actually issued securities to the market, tradable securities that mimic the payoffs of an employee stock option grant. And so when they auctioned them off to the markets, they were able to observe a market price, right? So sort of setting the fair value of their employee stock options. And the SEC did approve this approach. But as you might imagine, this is rather operationally heavy for the company. So there have been very few imitators as a result. Most rely on the Black-Scholes-Merton model with binomial tree extensions in the case of early exercise possibilities. Now, I had mentioned these employee stock options when they're exercised. Remember, the company issues shares. So, when does dilution actually hit the shareholders? As I mentioned before, markets are forward looking. It's not going to happen at exercise here. It's going to happen when the grant announcement takes place. And so that's when the market prices will incorporate the expected dilution sometime down the road. And then, of course, at exercise some years later, it's just a mechanical share issuance, right? It's not anything. No, the news has already been incorporated, right? So the share count's going to rise, but again, that's already an expectation. So there's going to be no additional price impact. Um, so in terms of employee stock options, there was a bit of a scandal, not a bit, a huge scandal in the early 2000s and the late 90s. There was a scandal across many different companies who were issuing employee stock options. And here's the setup here, right? So what they would do, for example, is issue at the money option, say at the end of April, and they observe the stock price at the end of April 30th, right, to be $50. And so they would strike they would issue those at the money options at April 30th, but they would backdate the reported grant date to a time in which the stock price was much lower, right? Essentially creating fake money for employees, payroll, right? So maybe in April 3rd, earlier in the month when the stock was $42, the result would be an $8 in the money option immediately. But by the way they were doing this, because they issued it on April 30th at $50, and with the share prices at $50, there's no expense per se, right? Because at that point in time. Um, but when they backdated it, they should have recognized an expense, that $8, right? Times however many option contracts are granted. Um, but no expense was recorded. Now, this is an example where academics actually discovered the fraud, the great accounting fraud of the early 2000s, and not the regulators. So the first paper to really take a look at this was David Yermak in 97, where he found that stock prices rose pretty precipitously right after the options are granted, right? Which is, far more than you might expect random timing could explain, right? This run up right after the options were granted. And then a few years later, Eric Lie showed that grants were systematically dated at the local stock price lows, right? So, like in that example, April 3rd. And it was done so systematically that it was just, he showed statistically that it couldn't have just been happening by chance. And then in a follow-on paper, he and Heron, showed that over 100 firms had to restate earnings as a result of this backdating scandal. The SEC obviously pressed charges against many of these firms, getting a lot of settlements out of it, with several executives here serving prison time for the backdating scandals here. And so this all wrapped up in a fair bit of accounting regulations that came out of this era called the Sarbanes-Oxley Act, where now CFOs and CEOs have to personally sign financial statements to ensure that they're doing it by the book, as it were. In our second part here, we're going to talk about index options. Okay. So in the US, right, we have options on indices. These are listed on, listed on the Chicago Board Options Exchange, or, through your broker if that's the way you're looking at it. These are typically cash settled. Most of them are European, meaning you can't exercise them early. The only obvious one that is an American style is the OEX on the S&P 100 here. Um, um, and generally speaking, as with all the other, typical, listed exchange traded options, the multiplier on these is also 100. Here, of course, it'd be 100 times the index, depending upon, which index we're looking at here. And because these are financials, they are cash settled as well. right? So what's interesting here, and I'll just kind of point to this now, and we'll come back to it later, is something called the VIX. The VIX is the ticker for the Chicago Board Options Exchange Volatility Index. So this is actually an index, right? It's an option on the volatility index. So its underlying volatility is not tradable. So we're not going to go too deep into that right now, but just know that it exists. You can, buy and sell options on volatility, market volatility. Okay. Now, here's a case for using index options for hedging purposes, right? So this is a portfolio insurance approach, and it's going to look very similar to a protective put strategy, which we've talked about in prior lectures. So, for example, if your portfolio largely tracks the index, right, um, we can buy put options on the index to put a floor, right, to cap our losses, as it were, if the market does go down. So the setup's pretty straightforward. If we define the portfolio value as V, the index level at S of 0, of course, the strike price is K, and we know that each put contract covers 100 times the share price, or the index level of the notional, gives us our notional value, then in order to calculate the contracts needed to hedge our portfolio, right? Say we're running $1 million in equity or equity. Um, in order to calculate the hedge ratio, it's just basically the value of our portfolio divided by the total value of the option contracts, right? 100 times the spot price. Now, that's the number of contracts we needed. The hard part is choosing the strike price in order to set the desired, max loss we'll take, the floor that we want to absorb. Now, it's pretty straightforward when the beta of your portfolio is equal to 1, right? It's really, simple, and we'll go through an example here. Um, the hardest part is when the beta is not equal to 1. And here we'll find that we'll have to scale the hedge, that is the number of contracts we needed. Sorry, not only the number of contracts, but also it's going to affect the strike price that we choose to hedge, right? And it's a non-linear hedge. And so we'll work through both of these examples. So now, when our portfolio's beta isn't 1, as I mentioned before, we can just scale the hedge in terms of the number of contracts by the beta, right? So, basically, if you have a beta equal to 2, your portfolio value is going to fall twice as much as the index for the same down move in the index. So essentially, the floor protection is going to require twice the put coverage, as it were, if your beta is equal to 2. And as I mentioned before, the other complication is that the strike price no longer corresponds directly to a portfolio value floor. We're going to have to translate between index levels and portfolio values. And the way we do that is to use CAPM to translate gains or losses on our portfolio vis-a-vis the index change. So let's take a look at a couple of examples here. Okay, this is the straightforward example where our beta is equal to 1. All right, so we're starting with a setup here where we have a $500,000 portfolio. So we've got a $500,000 in all equity portfolio, and we're concerned about the value falling by more than 10%. That is, we want to set a floor at $450,000. So here's our facts, right? Portfolio beta is 1, portfolio value of 500,000. I'm giving you S0 here. The index level is 1,000, and our desired floor again is 450,000 on the value of our portfolio. So a 10% drop is what we're worried about here. In terms of calculating the number of contracts, again, it's just going to be the portfolio value, 500,000, divided by the total option contract value. So if the index level is 1,000 in this example, and I'll kind of annotate this here on my other screen for you. Let me pull that up. Let's see here. Okay. Right. So our 1,000 here, that is our S0. And of course, the multiplier here is 100 times that. We end up with, needing to buy 5 put contracts in this example. So that's relatively straightforward. The next thing we have to determine is because our portfolio has a beta equal to 1, our portfolio percentage drop is going to mimic the drop in the index, right? That 100, sorry, that 10% I'm worried about. So since the index level is at 1,000 currently, a 10% drop would equate to an index level of 900. So to sort of solve this particular um, um, example here, then this is basically just buying five S&P index puts with a strike price of 900, right? So that's sort of the goal there. So it's pretty straightforward when we have an index, a portfolio with a beta equal to one. Now, what happens when our portfolio's beta is not equal to one? Okay. Well, before we do that, I want to walk through sort of the CAPM dynamics real quick here on the expected change in our portfolio's value for a given change in the index level. Okay. So here I have a beta of my portfolio equal to 2. It's the same portfolio value, 500,000. Okay. Um, the index is at 1,000, and I'm telling you that the risk-free rate on an annual basis is 12%, and we have a dividend yield here of 4%. So one way to think about this is if I want to hedge this, say, over a T equal to 3 month period of time, right? Um, we can give me 1 second here. The apologies. I'm gonna fix a couple things on my settings here before I can jump back into it here. Where did it go? That's what I want to do. Okay. So we're looking at 3 months out. So if, for example, if the index rises by, say, 40 basis points here, right? So the index price returns, sorry, not 40 basis points, but if the index rises by 40, given a starting price or a starting index level of 1,000, that'd be equivalent to a 4% return. Which means over this entire time period, right? That's just the price return. So our total return is going to be that 4%, right? It's going to be the 4% plus, sorry, my annotation's still not working here. I'll come back to it. There we go. Not sure why I can't get it to work here. Okay, so when we have the index goes up 4%, well, I noted here that the dividend yield is a 5% dividend yield here. I'm sorry, 4% dividend yield, which means on a quarterly basis, right? This is going to be equivalent to 1%, right? So that's where we end up with our total return of 5% here. That's how we identified that. Now, this is our total return, 5%, right? Well, given the risk-free rate of 12% on an annualized basis here, the equivalent of that on a quarterly basis, divide by 4 gives us 3%. So the excess return we have the over the risk-free rate, of course, is going to be this 2% here, 2%. Right, so we're kind of invoking the CAPM here a bit. So this is the excess return over the risk-free rate. And because our portfolio's beta is equal to 2, our portfolio's excess return, that is excess relative to the risk-free rate over this quarterly period, 3 months, is equivalent to 4%. Now, that means our total portfolio return, right? Because this is our excess return, this 4%. That means our total portfolio return is 7% when we add back the 3% risk-free rate, right? So our total portfolio return is 7%. In terms of the actual price return, right, we have to back out that dividend yield of 1%. So our total price return is 6%, right? So that's the total capital gaining, right, is 6%. And we will have received 1% in dividend, right? But what we want to know at the end of this period is the actual value of the portfolio in terms of the stock holdings, right? And so the actual portfolio price in this example is going to be the combination of, the growth of our $500,000 at that 6%. Again, we received a 1% in cash, but that's not invested. So the total portfolio value at the end of this period is $530, right? So we're invoking the CAPM here to sort of forecast, if you will, the price value of the portfolio in terms of the value of underlying equity in that portfolio. Right? So this gives us a sense for how we can potentially calculate different strike prices if we want to hedge this portfolio. So using the same example here with a beta equal to 2 or portfolio of $500,000, what we'll notice on the next slide is that our we're going to repeat the mapping basically across a bunch of different strike prices, and we can scale the contract counts by our beta. So in our prior example, we were most concerned about our portfolio falling to below $450, right? So in that example, we were most concerned about this value here. Now, when our beta is equal to 2, this is going to correspond to a strike price of 960 on the index level, going from 1,000 to 960. And so you'll notice here that these differences are nonlinear. This is the example we just worked on, right? When the index level went up to 1,040, it ended up with a portfolio value that was up, $30,000. And you'll notice that with a similar $40 move, but just in the opposite direction, right, from these two, you get a different sort of payout. That this essentially sets a floor at $450,000. So how do we determine, this 960, floor value? Well, we work through the same process here. By calculating effectively as in the prior slide, what the portfolio's loss would be, assuming those CAPM assumptions here. So working through that, we'll notice that here, the index only has to fall by 4%, right? You can very easily see that a fall from 1,000 to 960, that's a 4% move. And yet it represents, a 10% loss on the portfolio, effectively. And so that's, because a function of the beta, right, of the portfolio, because we have a beta of 2, it amplifies, it amplifies a loss, but the dividends fortunately offset it a little bit, so it's nonlinear in that regard. In here, so we've determined that the strike price is going to be 960. That gives us the floor. And then in terms of the number of contracts, well, it's going to be beta, 2 times the value of the portfolio, 500,000, divided by 100 times the share price of the share, the index level in this case is 1,000. So that's equivalent to 100,000. So we need 10 contracts here. So essentially twice the beta, you're going to get twice the number of contracts as example 1, even though the dollar exposure is the same. Now moving into currency options here. What's interesting to note about the currency options market is that it's dominated by the over-the-counter market. That is, exchange-traded foreign currency options are kind of a sideshow. And the reason for it is because of corporate hedging, right? So, imagine a multinational company with, let's say, $1 billion in British pound exposure on a specific date. They don't want a standard contract. They want something tailor-made, something bespoke in terms of the total notional value and the expiration date as well. In terms of the exchange traded options, you can trade them on the NASDAQ option markets exchange, which is the main one for sort of retail or standardized currency options. But again, the volumes are rather modest there. You can also, you know, the larger one actually is the Intercontinental Exchange, foreign exchange options platform. But generally, the interbank over-the-counter market is big. Now, one thing to flag, of course, is that because the over-the-counter market is so large, there's a lot of bilateral credit risk. And so that's a real consideration in terms of corporate hedging programs engaging in these over-the-counter markets. Fortunately, in the post-2008 era, there's been much more collateralization than there used to be. All right. Now, in terms of how to think about currency options, well, fortunately, it's rather straightforward in terms of the logic. It's the same as equity options. You've got a strike price, you have a spot, and you have the payoff per unit of foreign currency in this case, right? So let's take a look at the mechanics here. In this call example, a European call example, let's say it's a US firm, and they want a US firm that, is going to be buying the euro USD calls at a strike price of 100, I'm sorry, $1.10 per euro, right? So let's say if this is on $1 million notional or €1 million notional principal with that strike price of 110, if, for example, at maturity the spot rate was 115 US dollar per euro, well, that would mean, of course, the euro strengthened during that time period, meaning the long position in this euro US dollar um, option is positive. And so the payoff is rather straightforward. Of course, it's going to be the 1 million euro notional principal times the difference between the contract rate and the spot rate. So in this case, of course, the rate at expiration, you can think of this, in terms of the nomenclature that we've seen before, right? ST minus K, this is a call option, the difference between the two, right? We've seen this before. Um, and so in this case, the payoff is going to be positive, $50,000. If we take a look at the European put example here, um, here we're taking a look at the Australian dollar versus the US dollar. And this could be, an example where you have an Australian export firm that wants to buy, right, Aussie dollars, 10 million Aussie dollars at a strike price of 70 cents per Aussie dollar, right? To ensure against, the Australian dollar getting weaker. Okay. So, again, notional principal 10 million Australian dollars, strike price 70 cents US versus 1 Australian dollar. If at maturity, the Aussie dollar had become weaker, which is to say that the spot rate was 67 US cents per Australian dollar, then the payoff would be positive for this Australian export firm. That is the 10 million Australian dollars times the difference between, in this case, because it's a put, right? The strike price minus the spot price, right? And so we end up, in this case, with the Australian importer or exporter benefiting to the tune of $300,000. Now, one of the key insights here for foreign currency is just to think of the foreign currency as we've seen it before, is essentially if you're holding a foreign currency, you're going to earn the foreign currency interest rate, right? So it's economically identical to holding a stock that pays a continuous dividend yield. And so in this case, we're going to essentially think of the foreign risk-free rate of interest, RF, as being equivalent to that dividend yield, Q, right? And so we can effectively just replace it in all the formulas and go on as if nothing has really changed. So when we do price options on currency, we can just reuse the Merton 1973 model on dividend-paying stocks and just replace Q with the foreign rate of risk, foreign rate of interest. And so the whole, series of formulas, the Garman-Kohlhagen framework, is essentially just this substitution, which is what you see here. And so you'll notice here we're inserting, as it were, and I'll move this out of the way. We're basically just replacing, Q from that Merton formula with RF and the exponential here, right? And so once you do that, everything else kind of follows through the same way. And again, you'll see it show up here as well. Um, in terms of dealing with forward rate of interest, it looks very similar to as we've seen before in our prior lectures on futures and forwards here, um, to represent covered interest rate parity conditions here. Last but not least, we're going to talk about range forward contracts. Now, imagine the following from the perspective of a corporate treasurer, right? Let's say you're a US firm, and you're selling goods to a UK customer. And we know we're going to receive, say, 1 million British pounds in 3 months' time. Of course, you're the treasurer and you're going to want to hedge that. You want to hedge that position. Specifically, you want to hedge against the British pound becoming weaker over the next, 3 months period of time. Now, a plain vanilla forward contract um, is one way to go about solving this, right? When we could do that, for example, if we entered into, this 3 month forward contract at an exchange rate of $1.52 per British pound, we could definitely enter this position. We would end up, shorting, oops, excuse me, we would end up shorting the forward contract, right? Because we're concerned about the British pound weakening, right? And if we did that, we'd be able to lock in this conversion at on a million British pounds would be equivalent to 1.52 million US dollars. Okay. And we could do that. And that would be a very straightforward. Now, the problem with this is if um, the British pound actually appreciates, gets stronger between now and the settlement period, that 3 months from now, then the firm is, contractually obligated to pay, $1.52 while that spot is at 1.7. Meaning, if I hadn't have shorted, right, the British pound, I wouldn't realize a loss on my forward contract here. Um, and so that's the downside to hedging through forward or futures contracts is that it's symmetrical in either direction. So if you're wrong about the direction of the hedge, you do participate in the loss here. So in this case, it'll cost us $180,000 when the spot price goes from 1.52 dollars per pound to $1.70 per British pound. Now, of course, it would work in our favor if the British pound did decline to say 1.4, right? It could only buy $1.40 per British pound. Then we would, have saved some money. But the biggest issue is that, we don't get to participate on the upside. We're giving up that $180,000 windfall if the British pounds strengthen over that time period. So, treasurers and CFOs really hate this asymmetry. They're basically being compensated for downside risk, but they give up all that potential upside without any sort of, compensation. And so the structural fix for this is something called a range forward construction. So what we do here is we're going to replace the forward contract with a combination of a put and a call. And then we can determine the two strike prices such that it nets out our cost of this hedging program to zero. So um, here's the construction. So instead of shorting a forward contract, what we do in step one here is to set a downside floor. So we'll buy a put option at the lower strike price of K1. And we'll set it such that it's somewhere below where the equivalent forward rate was. We're looking in the forward or futures market of in our little example there of $1.52 per British pound. So we'll pick a strike price somewhere below that. And when we buy that put option, it'll protect us if the British pound weakens below, the spot price below K1, right? Below that strike price. And we offset the cost of buying that put by selling a call option at a higher strike price. And we're going to set that higher strike price K2 to be something greater than that forward rate, right? So something greater than $1.52 dollars per pound. And so we'll receive some premium, which will offset the cost of buying that put option. Okay. And then effectively we'll pick the strike prices such that, the put price is equal to the call price, right? And we'll choose those two different strike prices, K1 and K2, such that the premium cost cancels. So our net out-of-pocket cost is equal to $0. And so what we end up with here is, that's the sort of really clever part is that we're choosing, K1 and K2 to sort of bracket the effective conversion rate. So we're going to have a conversion rate that sits between these two values. Um, so here we're giving up some potential right tail upside above K2 in exchange for a range of acceptable exchange prices. And we're doing it for free, right? And this is essentially the same logic as a costless equity collar. We talked about collars last time in hedging an equity portfolio, for example. From a visual perspective, in the example that we talked about earlier, it was a short range forward contract. So we're receiving, say, British pounds in the future, right? So this is what a firm with a foreign currency receivable would be holding in terms of their position, right? So just graphically here, and I'll draw some pictures for you. Let's see, let me get some colors involved. Uh, can I get some colors? Stand by. I only see grays. Oh well. Nonetheless, we'll do it. We'll do it as best we can here. So remember, we're combining a put option, which is effectively what you see in this region of the graph, right? This is a put option. And then, of course, we're combining it with a call option. And let's see if I can do this. This is the written call option here. We're combining the two together, and we notice that when we do that, we end up with this short range forward setup. So basically, we're effectively able to do is when the foreign currency weakens, which is to say the exchange rate falls, our payoff becomes larger because our put starts to kick in. But when the um, when the if the foreign currency rallies above, say, our higher strike price of K2, remember we sold the call option, so we end up losing money as the share price exceeds, the exchange rate exceeds that strike price of K2. In this range, in the middle, both of these options expire worthless, which is probably the best outcome, given the fact that these options were set such that the costs were offsetting each other. Of course, your max payoff is if the exchange rate collapses. That is, in this example, the British pound collapses basically to something astronomical, meaning the dollar got really strong. Now, um, a long range forward is the mirror opposite. So this would be for for a firm with a foreign currency payable in a few months' time. Um, and both of them have the same shape. That is, it's flat in the middle here, um, and the opposite slopes on the outside, meaning in this case, the exchange rate increases, you start making money. And of course, if the exchange rate decreases, um, then you start losing money. Now, in terms of the construction of this one, you can kind of see visually what we're doing here. Um, uh, I'm just sort of going to mimic. In this case, we have a written put option. right? And so we'll earn some premium on that one. And then we take a long call position at K2, right? So this is, a short put at K1, and you can see that here. And then you buy the call option at K2. And obviously you would set the strike prices such that they were net zero to you in terms of the call and put premiums. Now, just to sort of summarize what we just talked about here, if you're receiving a foreign currency in the future, say you're an exporter, you want to put a floor on the downside here. That's where you buy the put at the lower strike price. And this is the most common one, right? Exporters with some foreign currency receivable, they want a floor on that conversion rate. And then in the case of an importer, um, this is, obviously in the case where you have a foreign currency payable, you're going to want to have a ceiling on what you'll end up paying. You don't want to pay more than some range amount. So it'll have the same structure. We're going to, in this case, just kind of swap the put for a call. And in both cases here, we're going to have a net zero condition, picking K1 and K2 so that the premiums are equal to each other. So the takeaway here is that these range forwards aren't a separate product per se. They're just an option structured forward contract effectively. So instead of engaging in the forward market, and having that sort of linear gain or loss, depending upon the direction of the foreign currency, um, we can use the benefits of put call symmetry around the forward rate to make the cost net to zero. So, from a corporate treasury perspective for multinational firms, exporters and importers, this is what CFOs and treasurers are want to do in terms of limiting their foreign currency exposures from a business operations perspective. So I'll leave you with some key takeaways here. We have four flavors of options with one common theme, just adjusting the Black-Scholes-Merton model for the assets underlying economics. So for employee stock options, the expected life is not going to be the state of maturity. So T is going to equal somewhere between sort of 4 and 6 years. Based upon the empirical evidence of employees' exercise life cycle investing, that the company has seen from their employees. And of course, vesting, dilution, and backdating, all these governance issues are, kind of behind us now. Shouldn't affect us going forward. In terms of index options, in terms of protecting a portfolio, right? A long portfolio of equities with index options, it's going to scale with how much variability, systematic variability we have with the index that we're choosing to hedge our portfolio with. In terms of currency, we're just going to augment the model to substitute Q, right? We're going to use RF instead of Q, but it's the same thing here. That is, the foreign rate of interest is a dividend yield, if you will, on that foreign currency. And last but not least here, we showed you that you can use range forward contracts, which is not really a contract. You set up through buying a combination of a put and a call, buying a put, selling a call, or, selling a call or buying a put, depending upon your perspective. It's net zero cost to hedge any foreign currency exposure of an exporter or an importer. Okay, when we come back next time, we will jump in and talk about the Greeks and how we can use these to help us better hedge our exposures in terms of written options from the perspective of investment banks, for example. Okay, and we'll see you then.